In the world of finance, knowledge is power, and perhaps no knowledge is more potent than the ability to predict market trends. Imagine knowing when a stock is about to soar or a currency is poised to plummet. This is the allure of trend prediction, a skill that can transform ordinary investors into market wizards. But trend prediction is not about crystal balls or lucky guesses. It's about understanding the intricate dance of economic events and their ripple effects on the market. By deciphering the language of economic indicators, central bank announcements, and geopolitical tremors, we can gain valuable insights into the future direction of market trends. This essay will serve as your guide to mastering this powerful skill. We will delve into the heart of economic events, unraveling their complexities and illuminating their impact on market movements. By the end of this journey, you'll be equipped with the knowledge and tools to navigate the markets with greater confidence and foresight. So fasten your seatbelts and let's embark on this exciting exploration of economic events and their profound influence on the ever-changing landscape of the financial markets. Imagine the market as a living, breathing entity, constantly reacting to a symphony of information. This information comes in the form of economic events, each carrying the potential to sway market sentiment and trigger significant price movements. But what exactly constitutes an economic event? In essence, it's any occurrence that can influence or is considered indicative of the overall health and direction of an economy. This can range from concrete data releases like GDP figures to more qualitative events like central bank announcements or geopolitical developments. Think of economic indicators like a country's vital signs, GDP representing its economic output, inflation reflecting its price levels, and unemployment gauging its job market health. Each indicator provides a piece of the economic puzzle, helping us understand the bigger picture. Central bank decisions, particularly on interest rates, act as powerful levers influencing borrowing costs, currency valuations, and overall market liquidity. Meanwhile, geopolitical events, from elections to trade wars, inject uncertainty and volatility, often leading to rapid market swings. Natural disasters, while tragic, also fall under the umbrella of economic events. Their impact on infrastructure, production, and consumer behavior can send shockwaves through specific sectors and the broader market. By learning to recognize and interpret these events, we can anticipate market reactions and make more informed investment decisions. Just as doctors rely on vital signs to assess a patient's health, investors depend on key economic indicators to gauge the well-being of an economy. These indicators provide valuable insights into the current and future state of economic activity, influencing market sentiment and driving investment decisions. Gross domestic product, or GDP. Considered the broadest measure of economic activity, GDP represents the total value of goods and services produced within a country's borders. A growing GDP typically signals economic expansion, often leading to higher corporate profits and consequently rising stock prices. Conversely, a shrinking GDP suggests a contracting economy, potentially triggering market downturns. Consumer Price Index, or CPI inflation, the rate at which prices for goods and services rise, is a key concern for investors. The CPI measures the average change in prices paid by urban consumers for a basket of consumer goods and services. High inflation erodes purchasing power, often prompting central banks to raise interest rates, which can impact borrowing costs and market liquidity. Unemployment rate. A healthy job market is crucial for economic growth. The unemployment rate measures the percentage of the labor force that is unemployed and actively seeking employment. A falling unemployment rate suggests a strong economy with increased consumer spending, boosting corporate profits and market optimism. Conversely, rising unemployment can signal an economic slowdown, negatively impacting market sentiment. Purchasing Managers Index, or PMI, providing a forward-looking perspective. The PMI surveys purchasing managers in the manufacturing and services sectors about their views on production levels, new orders, and employment. A PMI above 50 indicates expansion, while a reading below 50 signals contraction. By closely monitoring these economic vital signs, investors can gain valuable insights into the overall health of an economy, anticipate potential market movements, and make more informed investment decisions. Section 4. The conductor of the financial orchestra, central banks and interest rates. Imagine the global economy as a vast and complex orchestra. While various instruments contribute to the overall melody, it's the conductor, the central bank, that sets the tempo and guides the symphony of financial markets. Central banks play a pivotal role in shaping economic landscapes through their monetary policy decisions, with interest rates serving as their primary instrument. Interest rates, the cost of borrowing money, act as powerful levers influencing consumer spending, business investment, and overall economic activity. When central banks lower interest rates, borrowing becomes cheaper, encouraging businesses to expand, consumers to spend more, and the economy to grow. This often leads to increased market liquidity and rising asset prices. Conversely, when central banks raise interest rates, borrowing becomes more expensive, potentially slowing down economic growth and curbing inflation. This can lead to decreased market liquidity and falling asset prices. Central bank announcements, particularly regarding interest rate decisions, are eagerly anticipated and meticulously analyzed by investors worldwide. For instance, the Federal Reserve in the United States, the European Central Bank, and the Bank of Japan are among the most influential central banks, their pronouncements capable of sending ripples across global markets. Understanding central bank mandates, policy tools, and communication strategies is essential for navigating the complex world of finance. By carefully monitoring central bank actions and deciphering their policy signals, investors can gain valuable insights into the future direction of interest rates, anticipate market reactions, and position their portfolios accordingly. Section 5. When the world shifts, geopolitical events and their market impact. In today's interconnected world, the reverberations of geopolitical events extend far beyond the realm of politics, often sending shockwaves through global financial markets. From elections and trade negotiations to social unrest and military conflicts, these events inject a dose of uncertainty and volatility into the market, impacting investor sentiment and driving asset prices. Elections, particularly those with the potential to usher in significant policy shifts, can create a cloud of uncertainty, leading to heightened market volatility in the run-up to the event. For instance, a surprise election outcome that favors a more protectionist trade agenda might trigger a sell-off in export-oriented companies, while a pro-business administration might spark a market rally. Trade tensions, often characterized by tariffs and trade barriers, can disrupt global supply chains, increase business costs, and dampen economic growth, negatively impacting market sentiment. For example, a trade war between two economic powerhouses could lead to a decline in global trade, impacting corporate profits and stock valuations. Social unrest and geopolitical instability can also rattle markets, as investors assess the potential economic fallout. For instance, protests or political instability in a country with significant oil reserves might trigger volatility in energy markets, while a military conflict could lead to a broader market sell-off on risk aversion. Geopolitical events are inherently difficult to predict, but understanding their potential impact on various asset classes is crucial for navigating market volatility. By staying informed about global developments, assessing their potential economic consequences, and adjusting investment strategies accordingly, investors can mitigate risks and capitalize on emerging opportunities in the ever-changing geopolitical landscape.